Hello. Welcome to the Better Than Success podcast on September 20th, 2022. I'm your host, Marc Brown, self-professed loanaholic and licensed mortgage broker. Today, we're going to be talking about something that is near and dear to my heart, loans. For those of you who are following BTS and you're local to Philadelphia, just want to remind you that we have an event coming up this Saturday, September 24th, the off-market property exchange. Again, that's the Better Than Success off-market property exchange. That's happening at Better Than Success Studios, 2930 Jasper Street, number 103 in Philly. If you can make that, it's going on from 10:30 a.m. until 1 p.m. I was actually talking to one of our hosts today, Watson. He's super excited. He said they got people coming with deals. He's got people coming that are buyers. If you're a buyer or you have deals, you need to be in the building. Again, that's Saturday, September 24th at 10:30 a.m. Eastern Time. Definitely check in for that. And I want to introduce today's guests. I have my friend Dalton and his colleague, Thomas DeMartin. I just want to tell you a little bit about them because they're about to be your best friends too. Dalton is a lifelong, well, maybe not lifelong, but he's a mortgage industry veteran. He's had a storied past and legacy of industry-leading production in every role he's held. He's a 22-year pedigree in the mortgage industry, from retail to wholesale, encompassing agency, non-QM, and commercial products. We'll get into what the heck that means if you don't know what we're talking about. Most recently, prior to joining his current company, Logan Finance, he held a critical role in the development and implementation of a large national wholesale and correspondent commercial debt aggregator platform where he was taking investor takeout relationships and aiding in credit policy development and leading the sales. Tom DeMartin is also industry vet. He's going to be coming in with some fire. He comprehensive financial, analytical, and accounting background to his current role at Logan Finance. He's a young, focused, and determined professional who has spent the last 5 years working in the alternative credit environment, largely in risk-related capacities. He holds a BSBA with a concentration in accounting from Rider University and an MBA with a concentration in finance from Louisiana State University. For those who are uninitiated, that is the LSU. And Mr. DeMartin graduated with the highest honors in both programs and is a CPA certified eligible, having passed all his certifications. So these gentlemen are not any slouches in their space. And today they're coming on to talk about something that I think is a game changer, which is getting to the money, right? We're going to be talking about getting to the money. And if you are not already a BTS member, I don't know what's going on. Make sure that you plug in. We're going to be talking about how you can become a BTS member. You definitely want to check out Better Than Success. But if you're just here for the ride, without further ado, Dalton and Thomas, welcome to the game.
Hi, thanks, Mark. Thanks for having us.
Indeed. And gentlemen, I just read your prepared bios, right? If we could put it in layman's terms, what it is that you do, because obviously we talk, it feels like on an almost daily basis. We were just on a conference call this morning, Dalton, talking about some new projects that you guys are rolling out internally. How would you describe what it is that you do if you met someone, at a mixer?
Well, what we do is, we work for, Tom and I both work for Tom as the senior vice president. I help run the sales. So Tom runs all the operation and the credit policy, and I've some obviously some contribution to that, but Tom is really the brains behind that side of what we do. And what we do is we run a commercial debt aggregation unit for a major global investment bank. Our parent company is Neuberger Berman, which is a large $850 billion asset under management investment banking firm, and we run a conduit under the guise of Logan Finance that is in the business of table funding loans for mortgage brokers in a wholesale capacity, and also purchasing closed loans from lenders and banks in a correspondent capacity. So we seek out, the credit policy that we put forth that is agreed upon with our, our parent company, and we go out into the market and we aggregate those loans for them to be securitized and to mortgage-backed security pools. So that's what we do. We originate the debt and then in turn sell it off to our parent company, who in turn securitizes that debt, which is largely put into pension funds as an investment grade vehicles.
I love it. And so what you just said, I think is really important for maybe folks who don't understand how the mortgage industry works in the back end, right? Most people's experience with a mortgage company or a loan officer is just when they're going to get a loan and buy a house. Maybe if you're a real estate investor, like many of our members and followers of BTS are, you're having conversations either with a mortgage broker like myself, or you're going to the bank to get your money. But a lot of what your company does on the back end is you're actually finding investors for that money. And like you said, you're operating, what was that, 850 million or 850 billion?
Well, 850 billion is the assets under management of our parent company. We don't have that available to us in liquid funds. But
I wish we did.
We've been rolling out a lot more product for you, but
right.
Our job is to bring viable and tenable product to them that we have a marketplace for, that is going to give a return to their investors, and that they feel comfortable in the risk associated with those that credit policy we're setting forth with them. So being backed by an investment bank, we're a little more white glove in our approach to non-QM and private label lending. Or some of the aggregators out there, might have a different approach because they're coming to market and, they're searching out a whole pool of a myriad of investors out there that they can sell to that'll accept any kind of credit risk possible. We kind of have a box that we're trying to stick to and fit into, because we're in it for the long haul. We want to be around forever and really grow this thing, to what our dream is, to be, the largest in the country. I think. Yeah, right now, the team we have amassed right now is incredible. The turn times, we have a dedicated underwriting team, dedicated operations staff, just focusing on these loan types. That continuity of underwrite and that continuity of business flow, is giving us, increased familiarity every day with any kind of, issue that can arise, so we can address and identify it fast and quickly and resolve it. Our job is to give paths to closing to our partners that give us business as fast as we can. And I think the fact that we focus on this type of business, this is all we do, allows us that edge over the competition that isn't, it's spread across different, different product buckets and different agencies are selling to. And, we know exactly what we're doing, what we do well, what we don't do. And we identify those products right away.
I love that. And so, Tom, if you were to describe non-QM in two sentences, because a lot of people, even when you say the name out loud, I was talking to one of my business partners. You've talked to Brandon before, and he goes, non-qualified mortgage. It just sounds rough when you say it out loud, right? If you're talking to a client, we're having client-facing conversations. You guys are typically, your clients are brokers like myself that are sending over loan business. How would you describe a non-QM loan? Because obviously your company dabbles in both sides, right? You do conventional lending, that's agency loans that are going to Fannie and Freddie guidelines for underwriting, but then you're also for sure in your division focusing on non-QM. What does non-QM mean to you?
Look, at the end of the day, to describe it in one or two sentences is really tough. But if you look at it on its basic premise, it's just an additional way to qualify for a mortgage. So you have your agency guidelines, standard Fannie Mae, Freddie Mac, and then you have this entire segment of non-QM. Non-QM guidelines across the product spectrum in general are all going to follow the same sort of pattern. You'll see little nuances in between, and that's kind of what my job entails, is kind of figuring out what those nuances are, where to make our products better, where can we compete, where we can't. And that all has to do with risk. So if you look at non-QM from a risk perspective, it's going to be a semi-riskier loan, right? Which is why the rates are always going to be higher than a conventional mortgage or an agency style debt. But it's tough to put it in one or two sentences other than the fact that it's just an alternative way to qualify for a mortgage.
I think you just said it right there, an alternative way to qualify for a mortgage. I often have these conversations with clients because, even though we do a decent amount of business together, we could always do more, but most of my clients are still buying houses to live in, right? They can qualify for traditional lending. They can go to a bank for that. Obviously, we work with a lot of mortgage companies. We do work with some banks as well. They're looking for the 4 C's of mortgage underwriting, right? Mm-hmm. Your ability to repay, how much cash you have in the bank, what's your credit, and then obviously they want to make sure that the property is a lendable property. You guys are looking for those same things, but the way that you go about qualifying that, it presents differently to a consumer. So if I'm buying a house to live in and I, have a W-2 job or I have a business, I'm making money, I'm paying taxes, unless I got something crazy going on or I carry a tremendous amount of personal debt, I should be able to qualify for a home, a reasonable amount of house for, I'd say, probably 70%, 65, 70% of people that are either a W-2 employee or a business owner. Now, we have some business owners that they color outside of the lines, but most of those people, they're going to be able to check that box, and they're what we call bank, right?
Well, that's kind of you're touching on a very important point about non-QM. So exactly. Self-employed business owners traditionally will have trouble qualifying for an agency loan. And the reason why is because if you're a business owner, you are going to write off the majority of your expenses, if not maybe a little bit more than the majority of your expenses, right? And that means you're not going to, as you're truly making on your tax returns. For instance, a non-QM loan program like a bank statement program would be the right option for that type of borrower to qualify for more house, right? To get more money at the end of the day.
You just dropped a bomb, Tom. I feel like sometimes we forget how casually we just live in this world, right? You guys have been in the business longer than I have, so you're operating even at a higher level of competence than I am. But I'll be talking sometimes to a real estate professional or a client of mine who's an investor, and I say, hey, that if you've got some income coming in and you're not showing as much income maybe on your taxes as the bank would like, or you're claiming all of the legitimate business expenses, and so your taxable liability is low, we can't really use that money that you're not paying taxes on to qualify you for a Fannie Mae or Freddie Mac loan. But with a bank statement loan program like you guys offer, that person could potentially qualify. So if you could explain a bit how the income part works for someone who, hey, I've never done this before. Maybe they bought a house in the past. Maybe their mom or dad has a house, but they've never gone through this process. But they've got a business that's got good cash flow, right? They're making 6 figures a year. There's deposits hitting their account. But when it goes time to file their taxes, they say, hey, my accountant's job is to lower my tax liability as much as possible. But now that they've done that, I can't afford a house. I talked to the bank. They said I can't afford a house. How would you guys be able to serve somebody like that?
Well, that's the exact population that the private label non-QM industry looks to serve. There's law-abiding citizens taking advantage of all the tax loopholes and tax credit advantages they can by being a self-employed borrower. America's the home of the entrepreneurial spirit, and there's a lot of self-employed people out there, real estate investors that can't prove income. So that's we're serving the underserved there, where the agency and conventional market falls off and can't serve those borrowers. We're providing qualified mortgages for those borrowers still that we're testing their ability to repay. We're putting them in a situation where they can still afford the payment that they'll be given on a monthly basis. We're just finding alternative means to seek out that income that they're making, rather than traditional means of tax returns, W-2s, pay stubs. Bank statement loan, they're going to generally take an expense factor based on the industry that person's in. And they're going to, reduce that bank statement income based on an expense factor, and they're going to average that income over a 12 or 24-month period, depending on what program you're applying for, a 12-month bank statement or 24-month bank statement program. Take that amount, reduce it by the expenditure factor that's for that industry, or a P&L, that's generated by the CPA. Deduce that bank statement gross deposit income to something that's acceptable for their industry, and then see if that qualifies for the mortgage payment that they're looking to get, and the associated liabilities they have on their credit report.
Yeah, and to touch upon that too, another major difference, right, that we talk about is we don't have a roadmap in non-QM. Non-QM is a complete manual underwrite. There is no AUS approve eligible, and if you're not approve eligible, you're out the door, right? So that's where we'll come in, because we're doing a manual underwrite. A lot of this is common sense, right? So when you look at a bank statement program,
it's underwriting.
Yeah, it's pretty simplistic when you look at it, right?
That seems like like an oxymoron, right?
Yeah, look, I mean, at the end of the day, the guidelines are the guidelines, and they're pretty consistent across. But if you're looking at a bank statement program in general, you're taking gross deposits, you're looking at an expense factor qualified, usually one of three ways, and you're coming up with an income at that level after you're reducing for the expenses, and that's what you're going to use. Dalton and I, where we would specifically serve, is we're really on the business purpose side. So we're dealing with investors that hold many properties, and a lot of these properties are cash flowing, right? But the problem is they have such high leverage on their own personal balance sheet that they would never qualify for a full doc type loan program where you're looking at tax returns. And the reason why goes back to, okay, well, I'm writing off my expenses, and your liabilities are just going to be way too high. You're not going to be able to show the income. But from our perspective, we don't really care about that, right? We want to know, can that property itself produce the cash flow to pay us back the mortgage payments, right? And if that's the case, and if we can mathematically get there and make sense of it through the entirety of the underwriting process, we're going to write those loans all day. And this is just kind of what we do.
We're coupling that, obviously. We're coupling that with a sound credit history, and obviously liquidity in the bank, and so we're using ulterior means to support that, what we're deriving as far as the capacity to be able to repay the mortgage, rather than just looking solely on the ability of the house to cash flow and debt service.
Correct.
So it's not just there's a few factors that go into it, but it's certainly a less underwriting intensive process than a bank statement loan would be, or a 1099 loan, or a P&L loan, or these alternative qualifying measures that are out there in the private label non-QM space right now to get a person into a home. So it's a great product for those real estate investors, because again, we're not looking at the liabilities associated with any other properties that they own. We're not entering that into their debt schedule like you would for traditional conventional mortgage. We're looking solely at the subject property, the ability of that subject property to cash flow and debt service, and that's it. If it does, the borrower's got the credit scores, they have the liquidity to support those mortgages they hold, then we're off to funding a loan for them.
So what you just said there is a big deal. I don't think most people who don't know what we do for a living, these aren't even conversations that anyone's having with them, right? Sure. Typically, if you go to apply for a mortgage loan, it's this mysterious process to most people. The loan officer is asking you for a ton of information. It's like, give me your whole life financially, and then I'll tell you whether or not you're approved. It's either a thumbs up or a thumbs down. And for most people that are either home buyers or even professional real estate investors, they kind of go in with a sense of trepidation. They're nervous. They're like, hey, I hope this works out. What you guys are saying, and I know this because we've worked on transactions together, is you're going to have your underwriter look at the file and say, hey, does this make sense? Now, we still got to show ability to repay, because that's just mortgage underwriting, right? If you can't support the debt service, we're going to have a bigger problem. But I've seen we even have some options for that. We'll get maybe into the weeds with that later. But for the most part, a lot of the clients that we've worked on loans with together have been folks that are buying investment properties. The investment properties are cash flowing. The cash flow will cover the debt service, meaning the gross rents are going to cover the mortgage, principal, interest, taxes, and insurance. And because those rent payments will cover that, then we say, all right, well, what's the property appraised for? We're still sending an appraiser out to the house. They're still going to, make sure it's in good working order. They're going to make sure that, the property's worth what the person's buying it for, or if it's a refinance. We're looking for a value from the appraiser to determine the max loan amount. And then, hey, what's your credit? Let's go. We're not getting into the needs of what's your debt to income ratio. What are the minimum payments for your credit cards and your student loans and your car payment? That's none of our business. Like, the only reason we pull credit reports is so you can make sure that the person doesn't have any bad debt, right? Mortgages that they're not paying on time, a history of overutilizing their revolving lines of credit, or not paying back other debts that they've taken out on time. But I've never had a conversation with you guys for our investor clients about, hey, what do we have to do to reconstruct this loan so we can make the debt to income ratio work? Which I feel like for a lot of home buyers and even for some investors, that's like a big reason why they're unable to move forward in the home buying process. Now, as it relates to the bank statement program, because I think not enough people still know about that. If I'm a business owner and I have a business that's making money, I'm bringing in enough income to cover my expenses in life, but I'm still in growth mode. Maybe I'm not making 7 figures a year, but I've got a consistent 6 figures of income. When it comes time to file my taxes, if I were to write off all my legitimate expenses, I might not be excited about the amount of house I qualify for. What paperwork in particular would I have to show you to get approved for a bank statement loan?
Well, number one, we would need the entity documentation to show the business, right? And how it's operating. We would need the bank statements. Right. We need the bank statements for 12 through 24 months, whichever program, right? You have both a 12 and a 24-month program. 24-month program is obviously going to be priced a little bit better than a 12-month program, just because we're looking at more documentation and that consistency related to the income percentage that we're using is going to be more comprehensive. And we would need, obviously, to run a credit report. We would need to figure out what the expense ratio is via a CPA letter, something of the sort, or we could determine them based on a fixed expense ratio per whichever guidelines that we're using. And at that point in time, it's just standard mortgage documentation. There's really nothing further. And when you talk about what we look at in terms of the credit report, specifically, it's really related to payment history. All of these loans hinge upon payment history, right? So in the non-QM land, you're going to be more restrictive there in terms of what it is we will allow and what we won't allow. For instance, we're not going to allow any late payment in the last 6 months, right? A 30-day late within the last 6 months. We may allow one late payment within the last 12 months for a 1x30x12, but it can't be within the last 6 months. We don't want to see that somebody is struggling to be paying their mortgages back and then grant them a new loan. So at the end of the day, payment history is very, very important.
Nice. And so one of the things that I've noticed, because I've been, working with non-QM borrowers for a few years now, and, a couple of years ago, there were like a handful of non-QM lenders. In fact, that's how Dalton and I met. I was introduced to him through a colleague who was doing hard money loans, and they ended up turning over their servicing to Dalton's former company. And then Dalton and I became friends over email pretty much. And when he made the move to Logan, I came with him, and we've been rocking and rolling. And since then, I've introduced them to my partners. You guys have become, our go-to for these types of loans because you're turning them around quickly. But one of the things that I've noticed as more lenders are coming into this space, there's a very different experience from one lender to another sometimes, because as you said, there's no set playbook. If I'm getting a Fannie Mae loan or an FHA loan or a VA loan, there's guidelines that, are pretty much created by the federal government that state, hey, these are the rules for these loans. Anybody who's doing these types of loans has to follow these rules. individual lenders may add on their own rules on top, but everyone's working from this set of rules. When it comes to the non-QM space, it's kind of a free-for-all. You could have one set of rules for lender A, a completely different set of rules for lender B. Why is it that you think you guys are coming in and immediately, stealing relationships, frankly, right? Like you have brokers that were working with maybe another lender and they work with you. They're not working with that other lender right anymore. What are you guys doing differently that you're creating that momentum within your own business?
Yeah, I mean, I honestly love that question, Mark, and I'll kind of let Dalton follow up on it. But at the end of the day, we're in the loan manufacturing business, right? So you as a client, all of our clients out there, we're looking to problem solve, right? We have our own set of guidelines that we work around. Like I said, the guidelines are pretty consistent across the non-QM industry in general, but you will have your nuances here and there. Our greatest asset and our value to all of our clients is the fact that we're going to look at every single deal and we're going to try to solve whatever problems come up. And that's really where Dalton comes in. It starts with Dalton. So it's your relationship with Dalton where you discuss a transaction, you talk about what the red flags or the potential pitfalls could be. Dalton brings that transaction in, speaks to myself or the operations staff in order to figure out what the roadmap really is. Like we said, we don't have an AUS approved eligible. It's a manual underwrite. So it's more about how we present, put the documentation together, and package it so that it's a clean file and works for us in the secondary markets. So at the end of the day, we're really just problem solvers, working off a set of guidelines and trying to figure out where the solution fits in.
Because your responsibility to your team is on the back end when you're going to package those loans and sell them to an investor, securitize the loans, you need to be able to defend that file. Is that fair?
That's correct.
And that's why, again, when we talk about common sense underwriting, people, this is like a game changer. Now, I want to let Dalton pitch in, but I just got a couple of
big term we use all the time is big term we use a lot is prove it out. I mean,
prove it out.
Yeah, 30% of our fundings are exception based. And everyone modulates and mitigates their risk differently in this industry. And that's what Tom is saying. There's different nuances, but pretty much in the secondary market, investors are looking. The guidelines are pretty standard, but it's just the way that the front end originators, us, bringing those loans to the secondary market, how we want to modulate that risk and mitigate it. What we want to play into as far as what's available out there and what we can sell to. We don't want to play to that lower scale of credit. We're looking for better quality loans, better performing loans. It allows us to have better interest rates, allows us to have unlimited capital, allows us to have better service. But and again, we're I think a large component of why we're successful is definitely how tirelessly one thing is that Tom and I and our whole crew work. I mean, it's we have an amazing cohesive collaborative approach to loans. We all work together. We're an open book policy here. Brokers are constantly calling in, getting their questions answered right away, getting actionable answers, educated answers. And I think it's because we focus so much just on this side of the business that and we really just have a very smart crew of guys here. Is what it boils down to. These are veterans. They're people that are very concerned with getting your files closed. They truly care. They care about learning more every day, and we absorb that information, we retain it, and make sure we can apply it to the next loan that comes in. So we're giving the best service and the best answers, and getting these loans in and out of the market as fast as possible. Because obviously the biggest thing is when you're bringing a client to us, you want that client in and out of the market as fast as possible. They're satisfied, and then you're going to in turn get more business from it. That gets us more business.
Absolutely. What you just said, Dalton, I think is definitely something we need to really, really highlight, because these are loan programs that there's no magic parachute, right? waiting to save us all in the form of the federal government. The credit criteria is a little bit more strict when it comes to doing a non-QM loan. I would say across the board. What's the minimum credit score you guys will typically work with?
It varies by product. For a bridge loan product we're rolling out now is a 640 score. For our 1 to 4 unit condos, townhouses, we're at a 680. There's some state exceptions here and there, but generally 680. And then, for our our 5 to 8 unit and our mixed use, which is a 2 to 8 unit mixed use. And these are all the different subsets of products, 4 different subsets, just to give you an idea what I'm talking about here. So the 5 to 8, 5 to 8 unit residential, 2 to 8 mixed use is grouped into one product as well. That bucket starts at a 660. And then for our 9 to 30 unit, which also has a mixed use component in as well, that starts at a 680. And generally, what you see for people that have scores lower than that are people that are just, way overutilizing revolving credit. They're not paying it off on a monthly basis. There's judgments, collections, charge-offs that are rolling on their credit and haven't been satisfied. So those are generally the minimum credit score buckets, where you're seeing people that are still paying on time. Sometimes they're, overutilizing credit or, which is very frequent in the investor world. People are buying properties. They're exhausting credit limits on, credit cards because they're rehabbing properties, or they're putting CapEx into it, make sure that, they can get it stabilized and rented again. So we see a lot of that, and we try to make sure we're catering to those credit scores, where people are still making the payments on time, and they're still exhibiting ability to repay, and they're a good borrower. They're just when they recapitalize because of refinancing and cashing out and paying off the debt they accrued by getting that property in position to get it rented. Making sure we're still accommodating those borrowers. And, we have borrowers that come back to us all the time through brokers. We have some borrowers we funded, 24 loans for through one broker. And, we've seen their credit scores vastly.
We just had a closing 2 weeks ago. They already got another deal for me.
Yeah, exactly. And we see those scores vacillate, 6 months later, they'll be at a 738 when they were at a 681 because, they recapitalized, paid off their, all the revolving credit debt, got it to below 50% of max allowables. And their scores improved as a result, and obviously everything's tiered, it works in 20-point increments. If you're starting at a 680 score for our 1 to 4 unit property, debt service coverage ratio product, as you ascend 20-point increments to 700, 720, 740, 760, then 760 and up, the rates are all the same. You get better interest rates and better leverage.
Right.
So that's another thing to keep in mind as well.
What you just said there, that's super important because for my investor clients, right, if they're buying a property, they're doing forced appreciation. I know here in Better Than Success, we have a lot of folks that are doing that because they're looking to build and scale a real estate rental portfolio. So maybe they're doing a purchase, either making improvements using their own capital or leveraging hard money or private money investors. And then once they make those improvements, they're repositioning the property to rent it out and moving on to the next deal. So they may be coming to me to say, hey, Mark, I need to refinance. And obviously, the goal is to buy, rehab, rent, refinance, repeat. Well, in order to refinance and repeat, they need is max leverage, right? So they're trying to get as much as possible out. I know you said for 1 to 4 units, typically 660 or 680 is that bottom tier. But where's the cutoff from a credit standpoint where that person's able to come in and get max leverage, like they can borrow as much as you'll give them, which is typically what, 75% on the cash out?
75 on a cash out, 80% purchase rate and term. Yeah. So again, that varies by product as well. 1 to 4, 720 score we want. And, the market has changed and shifted recently, right? So, the secondary market isn't dull to the fact that, we're in somewhat of a housing downturn coming up, here, and things are going to be flattening a bit. So, credit scores have lifted a bit to get the higher leverages, where at one point we were at 680 to get the highest leverage. Now we're at 720. And that'll vacillate and ebb and flow.
Dalton, that's a big deal. Let's not gloss past that. Before, minimum credit score to get the highest leverage, 680. Now 720. So if you're not in the 700 club, you can't even get the max on the cash out. And I mean, we've done deals together, frankly, because you guys turn loans ridiculously fast and you have some of the most aggressive rates in the industry. There's some other lenders that I know that, I mean, their credit minimums are even higher because they're like, I don't want to say more scaredy cat. That sounds mean, but they're more conservative when it comes to the loans that they're willing to take on. Do you anticipate that that's going to continue to increase? That we're going to be at a point where maybe it's a 740 minimum to get the max leverage, or do you think 720 is about where we're going to stay?
In our 9 to 30 unit product, we are at a 740 for max leverage actually. But I don't anticipate that increasing. 720 is pretty much a baseline for really good credit, right?
Okay.
So I don't see that changing. I see those buckets maybe disappearing, those higher leverage buckets, but I don't think the
Really,
scores
we'll go from a 75%
75 cash out to a 70, or an 80 purchase rate in term to a 75 max across the board. I see that possibly happening, as the market matures a bit here and we get more into what's going on. But, obviously everyone's hoping for the best, but, we have to maintain a good capital market strategy to keep us in business, to keep our rates low. So we're not having defaults and buybacks and having issues with our loans. That's not what we want. So, we're making sure we're putting out good loans. That's obviously paramount every time. And that's obviously Tom's responsibility, the credit team. My responsibility, the sales team, is to get every freaking loan that closes that comes in this door, right? That's what I want. But, I have to couple that with Tom's responsibilities and making sure that we're putting good loans together. And, because that's paramount, obviously.
I think what you said is super important, Dalton. We've had conversations at 8, 9, 10 o'clock at night about deals where we're looking for reasons to close loans, right?
Yeah.
I think that everyone who's been to a bank or a loan officer and they maybe have a challenging resume on paper, they probably had a conversation where they felt like the bank or the loan officer was looking for reasons not to do the loan. You guys are instead looking to do the loan.
That's a common ethos in the industry, unfortunately, is, loan officer, underwriters are trained traditionally to, everything's a lie until proven innocent, right? And to proven true. And looking for a way to make sure, to not close that loan, and you have to really prove a way to get it closed. Our approach is obviously, we want every loan to close, find a path to closing. And, we try to train our underwriters in the capacity where they're looking at a loan, finding every way to get it closed, bringing it to Tom, because Tom's the ultimate decision maker, in addition to Chad as our head underwriter. So they're trained to, not just summarily deny a loan or slap conditions on that are just going to be impossible to clear. We try to find a path every time. And that brings me back to our adage here, prove it out. If we can prove it out, we can make it make sense. We can present it to our secondary and have a good loan still. It's not exactly in guidelines, but it still makes sense. And that's what we're looking to do every time. We want to get the loans closed.
I love that.
At the end of the day, we're looking for a supportable file, right? We want to be able to support that file in secondary markets. And look, our credit risk tolerance is different than other lenders, right? Everybody else has different credit risk. You have some lenders going lower, you have some lenders going higher, like you refer to as scaredy cats. But at the end of the day, we have our own risk tolerance, and that's set by our matrices. And that's kind of what Dalton was touching upon with regards to the FICO. That's where the entire transaction really starts. It starts with a matrix, right? So what's my credit, right? And do I qualify, and where do I qualify at? And that sets our initial credit risk profile for the loan. Everything else after that is pretty much just a confirmation of the guidelines. Does this meet our guidelines, right? Do we have 3+ trade lines reporting for 12 months or more, right? Are they making all their mortgage payments? What does the history look like? Do we have all the documentation surrounding the business, right? Have we vetted this out? Have we done an entity search? Do we have a certificate of good standing on the file? Like, who is this person? Have we identified them, right? Or are we clear that this is the right loan for us to do? And that's really all it is. So it starts with the matrix, starts with structuring, which is between you and Dalton. That loan comes in and we're kind of just vetting out that structure, and we're making common sense decisions to say, okay, does this loan make sense? Can we support it at the end of the day? And if we can, let's get it funded. Let's get it funded as fast as possible, and let's get it over to our investor. And that's kind of what separates us from other lenders out there, is we almost have that implied hedge because of our benefit and because of our relationship with Neuberger Berman, who is our main takeout for all of this type of debt.
I love it.
Critical thinking is definitely the most paramount aspect to having a good underwriter in the non-QM space. They're not robotic. They're not looking at an AUS certificate printout and making sure they're checking all the lines, and then it's not.
You get back the copy and paste from Fannie Mae guidelines.
Exactly.
This does not fit inside of the box.
That's why you'll see many of our approvals come back with, with literally the underwriter has typed in what that condition is, what he's trying to get at for it, and how we're trying to satisfy, because we can have 6 different ways to satisfy the same condition, right?
Yeah, I've noticed that, we on files that we worked on, I've even had to prepare my processors, hey, if you see a condition that you're not sure of, you can just call the underwriter. I don't think people appreciate that's not allowed with some lenders. Like, you just call the underwriter up and ask them questions. They're like, hey, underwriter's busy underwriting. You gotta go by the paper that they give you and figure it out.
That's the thing. It's like they're sitting in this like Fort Knox citadel, right? And it's like quiet time. Right. You can't talk to the underwriters, and we have a much more collaborative approach. And certainly, my business is to take that duress off the underwriters as much as possible, because I want them focusing on files. So I try to direct all questions to me first. But if it's something that's outside of my capacity to answer, I'm on the phone with Tom and chat or the underwriter right away to get an answer for you.
I love it. I love it. And one of our viewers, they said, hey guys, how much of a down payment is required? Now I'll frame that a little bit differently, because I've had this conversation with thousands of people. They say, hey, why do you guys need so much money? The property's making money every month. The rents are going to cover the mortgage payment. Why do you need such a big chunk of cash from me? So I'd ask that question first. Why is the down payment requirement higher for a debt service coverage ratio loan than it is for a loan where I'm going to be living in the house, Tom?
Well, number one, right, you're not going to be living there. So this is something that if it came to it, right, that's something you would be able to give up before you would give up your primary residence. And number two, we're not underwriting your personal income. So we're not underwriting your personal capacity to repay. We are solely relying on the subject property's capacity and your capacity as an investor at your experience level to ensure that that subject property pays, right? That you hire the right property manager, that you place the right tenant in the property, and that you vet that out and make sure that that property produces the cash flow in order for you to satisfy your mortgage payment. So because we're not underwriting your personal capacity to repay, that's why the down payments are larger. And look, the mortgage world in general is in a transition phase, right? I think we've all seen what's going on with CPI and our inflation. I think we've all seen what's going on with rates, and I think most of us sort of get it. But at the end of the day, the market for real estate is also transitioning. It has to, because as rates continue to increase, it creates an inverse relationship to the price. So that is all happening at the same time. And so mortgage companies and lenders like us are out there trying to make sense of all of this. And that's why you're seeing the changes in the matrices. And that's why you're seeing the reductions in leverages, because we're all trying to protect ourselves and make sure that not only are we protected, but our borrowers are protected and that their investments are protected, so that for the long term, we're not only partnerships with the broker, but we have a loan that we've underwritten for a borrower. We don't want to see that loan default, right? We want to see that borrower successful. We want to see them rinse and repeat, as you say, and come back for more, right? And continue to generate that wealth and that success through home ownership or through ownership of investment related assets.
And we're also doing our part. We're also doing our part to portend the viability of the industry as well, right? Because every lender out there starts putting as much risk out on the street as possible. And I lived through 2007, 2008. I was working for Lehman Brothers. I was at the forefront of it. We were buying up subprime assets all day long, and the market totally collapsed, right? So putting out good loans is not just good for our brokers and borrowers; it's also good for the market and the health of the market in general. And just to touch on the leverage for investment properties, 80% is also the max for conventional lending, right? For investment properties. So it's
you can go up to 85 on a primary or on a single family property if you're getting a Fannie Freddie Mac. But the pricing nowadays is atrocious. You're going to get set with loan level pricing.
Another aspect I'm going to say is that one thing we've been discussing is that we allow entity vesting on our investment property purchases. So you can invest in your personal name, or you can invest in an LLC or a corporation or a trust. and you can have different members of that entity, right? So if we have members of that entity that have deficient credit, that's not qualifying. This is the number one thing I do all the time in brokers. They said, hey, let's get another member of that entity that's got better credit, and then have them sign a guarantee for the entity. And because everything, we're a recourse, lender on everything. So we want a borrower to sign on behalf of the entity and guaranteeing that loan. But let's get that borrower with the best credit, so you're getting the best terms.
Recourse meaning if I don't pay the money back, you're going to come after me.
We're coming after the personal person who's guaranteed for that entity. Yeah, exactly.
Right.
So that person's being responsible for that. But it's a great way to subvert, having deficient credit for other members, is have, add a borrower who's got better credit so they can qualify. And additionally as well, we don't source or season funds on these loans. So you can aggregate, and this is common in the industry as well. People are aggregating funds from all different sources to pool to purchase a property. It happens a lot. So we're never sourcing or seasoning where the money's coming from. All we're doing is asking you to show that it's in a bank account, it's available for down payment and closing costs, and it's accessible, so you can come to the table with that money and purchase the property.
That is an ineligible asset.
If I have an entity with partners, I could take our personal assets and drop those in the bank account, and then show you those funds are in the account, and that's what you'll use to verify that I have the cash for my down payment and closing costs.
And you can even use a personal statement as well from that guaranteeing borrower.
Yeah, wow. as long as they're eligible assets, right? So like we're not going to allow you to take a PP loan and use that, right? But as long as it's an eligible asset, yes.
You're always like an underwriter. Tom's like, wait.
This is the dynamic between
with PP loans, and they've got 640 scores and not paying their bills, but they're taking their PP loan trying to buy a new property. So it happens.
Yeah, and that's something that
I think if I'm catching all of this, we're looking at, ideally 680 is probably the sweet spot, unless you're getting a bigger property. Maybe if we're looking at above four units, probably want to be over 720 to get max leverage.
Actually, for that 5 to 8 and 2 5, because so we're segmented on the how our different product sets, right? So there's a 1 to 4 unit condos, townhouses, which includes non-warrantable condos, warrantable condos, all go to max leverage. Slight pricing differences for those. Then there's a 5 to 8 unit and a 2 to 8 unit mixed use. So the 5 to 8 unit residential, then a 2 to 8 unit mixed use, which falls into another product set. That actually starts at a 660 score, and then the next.
Where's that max leverage? Where's that max leverage?
That max is 75. The 1 to 4 is a max of 80 purchase rate and term, right? And then on the next product set, the 9 to 30 unit, that starts at a 680, and for max leverage on that, you need a 740, but that goes up to 80 LTV, which is a very unique product for us actually. Having a 9 to 30 unit have mixed use as well. We want 50-50 square footage on residential.
You guys will do 20% down on a
20% down. Yeah, if you got a 25 unit property that's got 15 rental, it's got 20 rental units and 5 laundromats below it, and there's a even square footage split of residential and commercial. We'll go to 20% down on that. But it's a different quality.
I'm about to send out an email blast tomorrow morning. I didn't know about that one, brother. Okay.
Oh yeah, no, I try to send blasts out on that so everyone knows, but it's a different qualification method, which I know Tom's about to touch on. It's not a gross, so we're not just taking the leases at face value or the rent schedule from the appraisal at face value. We're asking for financials on that. We're asking for personal financial statement. We're asking for rent rolls, and we're actually, so it's going to be a net DSCR, DCF calculation rather than a gross. So we're not looking at the gross rents. We're looking at the net rents.
All right. So you're saying if you go beyond 8 units, we're going to play in a different pool for the underwriting, but it's still common sense underwriting. You just want to see that the property is actually netting, not what the top line revenues are, because that could be
it's a stabilized multifamily product that allows a commercial influence also, and we want up to 90% occupancy on those properties. And depending on the market tier, which is determined by zip code, the coverages are different as well. So what coverage we're going to ask for on that property, how it has to cover the mortgage. I'm sure
And
Tom
this
wants
has
to
to
say
be a single. This has to be a single structure. So I couldn't use this to buy, say, for example, four unit properties in a portfolio.
it's not a blanket. Yeah, no, it's not a blanket property. It can be different. Like we've had different, 4 different garden apartments all in the same lot being sold together that comprise 20 units, but it's all the same lot, same tax ID. But yeah, we can't buy different parcels and bundle them together and call it a 20. Yeah.
But if someone's got a 25 unit building, because again, this is 9 units to 30 units, in between 9 and 30, that's a big gap. You guys will end up to 80%. We just need to see the financials of the property. So obviously, if you're an investor out there or a real estate professional who's working with investors that are looking to offload these types of properties, and you can get a hold of those financials, you get them over to me, I'll get them over to Dalton and Tom, and we can maybe get that deal funded. And I feel like right now with property values pretty much peaking, I think it's fair to say I wasn't here during the last crash. And I don't think that it's going to look the same way that it did back in 08, 09, just because we know from an underwriting standpoint, the rules have changed dramatically. The regulation that's involved in our industry is night and day from what it was before. So I don't know if we're going to see a crash, but as Dalton described it, it's certainly a shift that's happening in the industry. And as a result, mortgage underwriting shifting, the behavior of property owners is shifting. We all are, dealing with the same thing. So whereas credit scores were, minimum credit scores were at one point a few years ago, now they're at a higher point because lenders want people that are more consistent with their payments. They have better credit habits because those are people that are going to be more likely to make their payments. Well, at the same time, you have investors that are like, hey, it might be time for me to cash out. This is about as good as it's going to be. This is about as much as my property is going to sell for. If there was ever a time to sell, it might be right now. And so when they're offloading those properties, you guys actually have a couple of different products that we can use to get them financed. That's a game changer. And I know we've been throwing around some terms that are probably scary for some people. So let's get into that real quick. And then I got a couple of questions I want to ask you guys. Debt service coverage ratio for the uninitiated is how business purpose loans for investors are typically underwritten. So instead of looking at your personal income and the debts that are showing up on your credit report, we're looking at, hey, what's the gross monthly income that the property is bringing in? What's the monthly debt service? And can those rents cover that debt service? And then if it can, I'd say up to 8 units, we definitely got some options with this call, right? If it's over that, 9 to 30, we still have some options, but we need to see the financials of the property to look at, not just the rent roll, but also what are the capital expenditures for the property ongoing, so we can take into account all of the financials to say, hey, what's the net income from this property? And does this satisfy the underwriting criteria that our investors are looking for? And if it can, then we have some options for that, right? For someone buying a property to live in, maybe, and they can't qualify for traditional conventional financing, we have some options in the form of bank statement loans, 1099 loans. We can look at P&Ls, again, common sense underwriting. If you're a home buyer and you've got a business that's bringing in cash, you got good savings, you got good credit, but your taxes look like trash to a mortgage person because you're not paying, the most that you possibly can in taxes because you're writing off legitimate business expenses. You're a nightmare for a bank loan officer, right? You go to a Wells Fargo, Bank of America, they're going to tell you to kick rocks. But if you come talk to someone like Marc Brown, I can put you in touch with my guys over at Logan, and we've got options where we can literally use a percentage of the monthly deposits that are coming into your business account. Do you guys do personal bank statements for your bank statement program, Tom?
Sure.
Yep. Yes, we do.
Major key. So that's a big deal. Like that, if I got a business that's bringing in cash, but my taxes don't look great because I'm trying to limit my tax liability, that could literally be the difference between me being able to buy a home or not. Or what I've had to have certain clients do in the past is they had to file their taxes and increase their tax liability just so that they could pay taxes on enough income to qualify for conventional financing. What you're saying is, hey, save on the tax bill. Yes, you're going to have a higher down payment. What's the minimum down payment right now for your bank statement programs if I'm getting max leverage?
Primary residence is 15% down. Investment properties are 20.
Wow.
And again, that used to be a 10% down for primary residence, but again, with the market shift, we pulled back on that to 85 LTV or 15% down.
And I think we're seeing it across the board. There's some companies that didn't pull back. We had a conversation the day after Sprout shut down. Sprout Mortgage is one of the bigger players in the country for non-QM lending, and they had a reputation of kind of living life on the edge. They were the opposite of Scaredy Cat. They were like, we'll let them on anything, and that ended up biting them in the butt because they ran out of buyers for their mortgages on the secondary market. Is that fair, Tom?
Yeah.
That and a lot more, but yeah. That and a lot more. You're bringing up the bank statement. You're bringing up the different things you could do with a bank statement program, Mark. So like if you're using a personal bank statement, let's say I'm a self-employed business owner and I have my business account, right? But every single month I'm paying myself into my personal bank account. As long as I could show that, hey, I'm not commingling my funds and this is my true income from the business, we'll take 100% of those deposits. But what we need to see is that they're not commingled, that you have a separate business account that's paying those expenses. So you give us 3 months worth of your business bank statements, and then you give us a 12 months worth of your personal bank statements, and whatever that amount that you're sending yourself, we're going to use 100% of that without that expense factor.
Yeah. Whoa. Hey guys, if you're a self-employed person, or a self-employed person and they're not on this call, they're missing out on gems. Again, for those who were listening, Tom just said, if you have a business and you structure your business finances accordingly, where you have a business account that's receiving your business's revenue, and then you're doing a payout to yourself as the owner each month to your personal account, they'll use 100% of the deposits into your personal account to qualify you. Now, again, we're looking at this over either a 12-month or a 24-month period. But when we talk about planning your finances to make sure that it's in line with your goals, if you have a goal to become a homeowner in 2023, for example, because you have a business that's starting to pick up steam, you're doing well, you came out of COVID and the quarantines and everything, and your business is growing and blowing, you want to set that up so that you can structure your deposits each month so that you'll be able to qualify for financing. And we don't care about your tax returns. We're not asking you to pay Uncle Sam a huge bill and take on the maximum tax liability. And then now you got to worry about paying Uncle Sam and coming up with your down payment money. You can focus on growing your business to be as big as possible, paying yourself an amount each month. And as long as we can document that, we can use those gross deposits. That right there, I mean, there's some business owners that I've talked to that, I probably need to go back and once this recording's logged on YouTube, I got to send this interview over to them because that's a game changer. So again, debt service coverage ratio loans for investors. We have options from 1 unit up to 30 units. We've got business bank statements, personal bank statement loans available for folks that are buying both investment properties and primary residences. And if someone's a 1099 worker, one of the things that I've seen a lot, especially coming out of 2020 when everything was shut down, people weren't going anywhere. If you were even going to get your groceries, my business partner, she didn't go to the grocery store. I don't think she's been in the grocery store herself since 2019. She orders everything through Instacart. So you have people that are doing delivery work, and they're doing these gig jobs where they're getting paid 1099. You guys can even use the 1099s to qualify somebody. How does that process work, Tom?
I don't know that we still have the 1099 program. Dalton, do you know?
You guys cut out the 1099 program?
Well, we have a 1099 program. It's coupled with a bank statement. So what they're going to do is they're going to take that 1099 and make sure the deposits are supporting the 1099 income.
Okay.
You know,
So it's not.
I had one come in recently where there was, you know, they had year-to-date bank statements, and there was a total of, you know, $13,000 in deposits in the bank statements they gave us, but the 1099 was showing $160,000 last year, right? So that it didn't make sense because it didn't jive. But it turned out they had another bank account that didn't send us, so we had to get the other bank account and couple those statements and show, so we can join the statements, couple them together, and we're able to prove out the income. So it's going back to what we're saying. If we can prove it out, we can make sense of it, then, you know, it makes sense. But you can't have a 1099 that's going to show, you know, $15,000, you know, or $150,000, and then bank statements are only supporting $15,000, right?
Yeah, we don't have a specific 1099 only program, right?
Yeah,
it's a 1099 program, but there's that bank statement dynamic to it.
It's designed for contractors, people that are, you know, maybe not a W-2 employee. They're getting their income through 1099s.
Exactly.
A combination of the 1099s that they receive from their clients, or if they got a, you know, exclusive contract, maybe combine that with their deposits into their bank account, and that's how you're qualifying them.
Yeah, we're just making sure the bank account deposits support that 1099 income if they're showing on that 1099. Sales agents, you know, real estate agents, you know, your Mary Kay makeup, you know, sales agent, anyone who's in a 1099 capacity, we'll accept the 1099, but it's not pure just only 1099. And that product does exist in the market. I'm not sure if it's still around, but at one point there was a 1099 only product, but again, some of that risk is being taken off the table as this market matures a bit.
Listen, these are the things that are important to know, because is it safe to say that even if I had a conversation last summer with a broker or a loan officer from a non-QM lender, that the rules have changed even in the last year, heck, in the last 6 months? You know, we've seen, it feels like every day I'm getting an email with an alert that another mortgage company is either having mass layoffs or shuttering their doors completely. What's your plan for making sure
you mentioned Sprout already, right? They were the largest in the non-QM space. You know, they were funding the most amount of volume by a very fair margin. And, putting the most amount of volume out there isn't always the best thing, right? Some people are racing for the numbers to put the most amount of risk out there so they can pump their numbers and have them, you know, the biggest amount of fundings. And you know, that's, you know, obviously our goal is to grow into, you know, a large volume lender, but, you know, the number one priority needs to be make sure we're putting good risk out there.
That makes sense.
And some lenders, you know, their capital market strategies are different. Their risk, their approach to risk is different, and you know, unfortunately, they're paying, you know, they're paying the price for it right now. And you know, two of the largest in the country, you know, First Guarantee and Sprout went out of business as soon as the market changed. You know, they were left holding the bag on loans that they couldn't. You know, they mispriced the market, they mispriced risk, and they couldn't get rid of it. You know, and then they're sitting with all this risk on their warehouse lines, and they're not able to support it. The warehouse lines, you know, issue margin calls. They want their money back, and they don't have the cash on hand to take out those loans. And all of a sudden, they're going bankrupt.
Wow. So
that's what we're trying to avoid. And I don't think we'll ever be in that space, especially with guys like Tom running the show.
I love it. And so going forward, you know, we're in September 2022. What are your predictions for where the industry's headed in the form of non-QM loans? What's your strategy for Logan Finance on how you guys are going to continue to be a resource for brokers like myself, and how you're going to, you know, obviously be able to get deals done for borrowers out there who don't maybe qualify for traditional loan products, Tom?
Well, so what we're seeing, especially in the investor marketplace with an increase in interest rates, right? And it's what I kind of keep telling our clients is when you're out there and you're talking to your borrowers and your clients, these single family residential loans that are trying to go DSCR, right, for Airbnb, et cetera, whatever the investor thinks it's going to be, they're just not qualifying anymore. With par rates going, you know, 7.5% to 8% on these loans, they're just not qualifying. The rental income's not there to support it. So what I've been telling a lot of our clients is to start to attack the larger unit, right? Go after the 2 to 4s, go after the 5 to 8s, and especially this new, you know, stabilized multifamily product that we have out in the market now, because those are the loans that are going to still make sense at higher rates. And that's one big change in the dynamic. A year ago, it was all single family DSCR all day and everything was covering because rates were so low. Nowadays, it's a completely different story. So that's what I advise our sales staff, to be looking for. And that's what they're advising their clients and our clients and the brokers is that, try to look at these deals before you take them on so that you can advise your clients what the right path forward is. For instance, it may not be right to go DSCR on one of these loans, right? It may be the right option to go bank statement for a loan that's not qualifying on a DSCR basis.
Wow. And what you just said, I know that you guys have been a resource for me. We've been able to do some business together. I think we're going to continue to do a lot of good business together. But I know we have some real estate agents that are in our audience and probably tuning in on YouTube. What you just said is a game changer, maybe for someone out there who is noticing that they're having less home buyer clients, right? Prices are up, rates are up. At some point, like you said, there's downward pressure on prices, upward pressure on rates. Something's got to give. And so they're maybe seeing less activity. I talked to a real estate agent out here in California earlier today, and she said, "Hey, I'm bone dry right now. All my clients are $10 million plus buyers, and no one's moving on anything because rates are up. And so they don't want to take their money out of their other investment vehicles and move it over to real estate because if they're borrowing money, the cost of that money just doesn't make any sense for them right now." And so she's just kind of sitting there twiddling her thumbs, waiting for the market to adjust and see what happens. Well, our real estate agent is working with home buyers. And now maybe I'm shifting my focus to say, hey, who's going to continue to do deals in this new reality, this new market, where we're not in 2, 3, not even 4% interest rate market anymore. You're saying that it sounds like there's some opportunity in that multi-unit space, 2 to maybe 30 units, because you guys have a home for the loans. And so if someone's got a property that's cash flowing, because people still need a place to live. So in a market where retail sales slow down, that just means that there's going to be more investor activity. Is that fair?
Yeah, and that's one of the major points, right? So as the affordability of a home has drastically increased, right? It's hard to afford a home, right? So it's the price is so drastically different, and the total cost for a mortgage is so drastically different from where it was, let's say, a year ago. What we're going to see is these people are going to become renters again, right? They're going to have to rent. They're still going to need housing. Everybody always needs housing. So the 4 units, the 5 units, the 6 units, that's where that market's going to be. It's not so much for the single family, because these loans are not going to work that way. If you want to buy a single family rental property, that's great. But what I could tell you is that if it's not cash flowing on a gross basis, then guess what? You're going to be coming out of pocket every single month, because on those loans, we're looking at everything on a gross basis, right? That is not the true coverage, right? True coverage is going to take into account all of your expenses, right? And that's not happening on these loans. So that DSCR product in general is just really a bastardized commercial product that we've brought to market to really boost that investor market, and it's worked flawlessly. But as rates have increased and as prices have kept up with that, and before there is no break, it's just not going to work. Those products aren't going to work anymore. So, but what we do find typically is your higher unit properties are what we cover on a gross basis very easily. And those are cash flowing properties. So that's where the investor should be attacking, right? I think that the single family residential market is going to slowly die off, and it's going to have to wait for some price compression in order to come back.
Wow.
And we're really seeing a shift in our broker base. Brokers who, you have to think how underserved this market was in the last 5 years. We've had this massive rate boom, lowest rates in history. People are borrowing at 2%. It's a really underserved market, this investor multifamily market as well, mixed use, because that hasn't been getting as much attention because they've had to go to banks and non-traditional means to try to secure financing, and there hasn't been a real broker population, wholesale population focused on bringing that business in, because they've been selling 2% interest rates and agency loans, and there's been an abundance of credit, and there's been abundance of loans and transactions, and it's been really easy. So now things are tightening up, and that market's still out there underserved, and that product penetration in that market, it just like you said, a lot of people don't even know these products are out there because they haven't been they haven't been utilized because the brokers haven't been focused on them. But now we're seeing a huge shift in our broker population moving away. They're bringing more and more of this business in and migrating away from that agency business because there's not as much of it. So they're really shifting their focus, repositioning themselves in the market, and finding how they can still maintain pipeline flow and bring loans in. And one way to do that is really focus on this product set in the market because again, it's there's a lot of it out there. It's a $1 trillion market estimated on a yearly basis, the investor market. And there's plenty of it out there to be had right now. So especially now we're seeing price suppression, happening. Investors are, like Tom said, the multi-units are the ones that are qualifying better and cash flowing more, and that's really the focus is going to be. So, moving forward, that's where we see the market going. We see the multifamily market growing, and hopefully ameliorating some of the loss we're seeing in the single family market.
I love it. I love it.
And we'll see this eventually balance, right? It has to. Mathematically, it has to, right? Real estate has to compress because, like we talked about, the affordability. A home that was once very affordable for a borrower a year ago is no longer affordable today, right? And so at some point there has to be that levee break, and we have to find that equilibrium and that balance. It just hasn't happened so much yet.
That makes sense. And so as we navigate, the next, I'd say, what you think, 6 to 9 months before we see maybe a transition to the other side where there'll be like some serious price compression, because I'm already seeing it in a lot of listings. Before, sellers were just slapping a property up for whatever, and even if the property appraised under when we had a financing contingency, buyers were like, all right, I'll cover the difference, right? I'm going to lock in this low rate. I'm going to be in this house forever or for the next 10, 15, whatever years while I'm raising my family. I want to be in this neighborhood. I don't care. Maybe they just sold a property that they had a ton of equity in, and so they were able to make a larger down payment. Now, when appraisals come in lower, people are looking at, hey, I guess we're renegotiating the price. For you guys, as we're moving forward with both investor clients and home buyer clients.
That's a really important aspect to touch on right now as well, actually, is that we're seeing a lot of delistings, people taking properties off market. They're not getting the price they want.
There it is.
Yeah, so we're seeing it absolutely, and we're seeing them want to move on to the next project, and they need to access that equity, unlock it. So they're coming to us for DSCR loans to get that equity out, take the property off.
That's it. Listen, real estate agents, listen up. Dalton's giving you a tip. If you have somebody who has maybe over leveraged themselves, they ran it up, getting the property turned over, or they have put top of the line finishes in the property, and so they're emotionally attached to a higher number, and it's just not happening. There's no buyer that's willing to pay that. Those listings are going to start turning into refinances and holds, because again, if there's less seller and buyer activity, that doesn't mean that people no longer need a place to live. That just means that they go from the new buyer in the neighborhood to the new renter in the neighborhood. Somebody's still going to be living in that house.
And now's the time to get those appraisals in. You still have supportable comps within a 6-month sales period that are going to give you that higher valuation, so you can max the equity out of that property and get cash, move on to a next project. And we're definitely seeing a swift turn to that right now with buyers. And another thing to keep in mind, one of our guidelines, which is an important guideline to have, is that we just need a property taken off NMLS, and you can still cash out to max leverage, and we'll allow no prepays on it as well, because a lot of these investment properties have prepays on them, right? Right. Or you can price without a prepay. A lot of lenders want at least 3 months from delisting in order to cash out. They want 6 months seasoning from the delisting. We'll do it one day off the market. So as long as it's off the market, we'll allow you to cash out still, and we'll allow you to price without a prepay if you want to do it without a prepay.
I love it. Well, guys, I'm not going to tie you up for much longer. I got a couple of quick questions for myself and then from some folks in the audience. So Julia said, will you lend in Puerto Rico? Or, I know you guys are lending all over the U.S. Will you lend in Puerto Rico?
No. Puerto Rico,
Okay.
U.S. Virgin Islands. We don't lend in any of those outlier islands, unfortunately. In Nevada, keep in mind, we don't lend in Nevada either, unless you're a lender closing loans, or we can buy closed loans there.
Is Nevada the only state in the continental United States that you guys will not lend in?
Yes.
Wow.
No,
so in 47 states, you guys are lending.
Yeah, the DSCR investor products, yes.
I love it. I love it. So if you're an investor and you're, in Nebraska, Idaho, South Carolina, North Carolina, Texas, wherever, we got some options for you. For sure. I appreciate you guys coming on. I know that you have busy schedules just like I do. So cutting out some time with us this evening is a big deal. And this is definitely going on to the Better Than Success YouTube channel. So hopefully we'll have lots of lead flow coming through. I'll have some loan scenarios coming through for people that are reaching out for your non-QM products. And I want to thank you guys for joining us.
Yeah, thank you, Mark. We really appreciate your partnership. And just to know, I just saw 2 of your approvals just come out at 8:20 at night here. So
nice.
That's how hard we work.
Yes,
this is what we do. This is what we do, right? And
this is why I like you guys. Dawn's always like, hey, we got 2 more approvals. That means we got space for 2 more, Mark. Send them over.
Well, look, the market doesn't sleep, and we're here to move fast. We want to get these loans through the process. We want to get closings, right? And we just want to do deals all day long that make sense. That's it.
I love it, guys. I love it. I'm gonna let you go. I'm gonna stay on for a bit and talk to maybe some of the folks who are not already a part of Better Than Success to tell them how they can get down. And for sure, we're going to talk very soon. I actually have a follow-up question for you guys about that scenario I sent over to you last week in Philadelphia, that 8 units. So I got some more detail. I'll be following up with you guys via email, okay?
Yeah,
Sounds
perfect.
good.
Thanks,
Thank
Mark.
you,
We
Mark.
appreciate it.
Not a problem, guys. Have a great night.
Yep.
You too.
Indeed. So for those of you who are not already a part of Better Than Success, but you maybe been following us, what are you doing? Get down with it, get down. Right now, Better Than Success is on fire. I'm on fire. Our executives are on fire. We're doing events literally every other week, it feels like, at the office in Philadelphia. I've been bringing on some absolute monsters. If you don't know what was happening just now, if some of these questions were confusing to you and you have goals to become a real estate investor or to grow your real estate investing, maybe from 1 property to multiple properties, you probably need to be a member of BTS, because you can learn the language of real estate, learn the language of loans, learn what we're talking about, and then it's going to make you dangerous in the marketplace. So right now, if you're not a member of BTS, I highly encourage you to go to betterthansuccess.com/BTSREL. If you go to betterthansuccess.com/BTSREL, you put in the code MARC. That's my code. You can join for 30 days for $1. Again, 30-day trial for $1. If you don't see enough value in 30 days of actually engaging and interacting in the group chats and going through our new members course that we have in the back office, I don't know what to tell you. There's no hope for you. No, I'm joking, but I'm not. So again, betterthansuccess.com/BTSREL. Put in the code MARC, MARC, and you can get a free 30-day trial. Well, $1, I consider that free. And this is what we're doing on a weekly basis. Every Monday and Friday, we have our group coaching and accountability calls. That happens literally every week. Every Monday, Nicole, our founder, also goes on and does our real estate news briefing live. Every Tuesday, we have our deal analysis lab where we're actually analyzing deals, because the only way to really do real estate is to do real estate. And sometimes if you don't have people around you that are moving in the same direction that you want to, it's hard for you to imagine what it looks like. And so we're analyzing deals real life so that you can get in the habit of looking at real estate deals, learning the language of real estate, speaking it, feeling it, you're living it. It starts oozing out of your pores. Everybody you talk to, you start nerding out about real estate. And then you're going to notice that over a period of time, you're going to have opportunities show up because you're speaking about real estate, but it has to start with you and the conversations you're having on a daily basis. Every Wednesday, we have our real estate mastermind. That's coming up tomorrow. I forget who our guest is this week, but we're going to have somebody fire on because we always do. And then Saturdays, we have our workshops and our trainings. I know this Saturday, obviously, we have our off-market deal exchange. And I'm also going to be doing another BTS podcast recording where I'll be interviewing my good friend, Rod Stanback, about his hard money lending company and his rise from, college dropout to a real estate millionaire who has his own lending company, has a great portfolio, and a great family. I think is super important. So again, betterthansuccess.com/BTSREL, put in the code MARC. You can join BTS for $1 for 30 days and, stay for a while. Let it wash over your body like the waters of Lake Minnetonka. And tell me if you stay here for a while and get active if things don't start changing for you in real estate. So again, thanks for joining us this evening. My name is Marc Brown, aka MARC.loans. I'm a loanaholic. If you have use for a local mortgage expert, myself and my team, we're actually accepting new clients. So tell a friend to tell a friend about me. Have a great night.